Welcome to the WA Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. On this episode, I interviewed Monika Jazyk, who's a real estate investment specialist and wealth builder and the founder of RPI Education. She's a driven entrepreneur who's passionate about helping people build wealth through real estate. And on this episode, we talked about why RESPs are unproductive, her personal experience with them, why Monika sold most of her real estate portfolio in 2020, how she has shifted her investment criteria, why she's exploring midterm executive rentals, and her recent Florida development project. So I hope you guys will enjoy the episode. Make sure to leave us a review. That always helps us get the word out there to make sure that people are hearing this, that they're hearing a good message and they're getting into real estate investing, because we all know it could change your life. And one more thing I'm going to ask you to do is just share this episode to your Instagram story if you like it, either through Spotify or by simply sharing the link to Apple if you're using an iPhone. So there you go. I appreciate all your support, and I hope you'll enjoy the episode. All right, here with Monika Jazyk. Thank you for joining me today.
Thank you for having me.
All right, tell me about your childhood. Where did you grow up?
My childhood. Oh, my goodness. We're going way back. I'm very old.
We always do.
Well, I actually grew up in Markham, but everyone from Markham is originally from Scarborough. So this is my theory anyways. So I moved to Markham, I think when I was about 6, 7 years old, but born in early years, Scarborough, Centenary Hospital baby. That's me. Probably like 99% of the Markham population my age.
Yeah. Tell me about a memory. Like, what do you remember from that time in Markham? Anything that stands out to you?
Well, I remember Markham was not developed at all.
It's always real estate.
Yes, it always really goes back to that. And this is when people pretty much there was development in Markham. But right now we live near the Markham Stouffville Hospital. And one of my memories of going to the hospital to just doctor's visits was actually literally driving through cornfields. And so the actual hospital existed in a maze of cornfields. It was just so underdeveloped. It was incredible. And so everyone thought my parents were crazy for actually moving to Markham originally from Scarborough. And because there was just such little population there and such underdevelopment. So I remember I'd do a lot of walking as a kid, and even to walk to the store. That was my big outing. It would take me about an hour, and I would walk across the farmer's field to get to a store. Mm-hmm. And today, that's whole farmer's field and all the farmer's field around are subdivisions on subdivisions on subdivisions.
Yeah. Oh, yeah. I'm sure there's tons of people that have that kind of memory. Like even in Brampton, where I was sometimes when I talk to the locals, they'll just say, well, all this was just empty and just farmland and whatever. It's kind of weird to visualize it myself. But anyway, let's talk about your journey. What do you want to share with us about how you seem to really love real estate, because you talk about it all the time.
I love it.
Why don't we just actually start off by talking about the RESPs that you were mentioning to me about your son now being in university and how you guys were saving for him, and tell us a bit about that.
Oh, my sad RESP story. We're just going way back again. Well, I always knew that, finance and savings were important. But what I didn't know was that I wanted to be a stay-at-home mom. And after we had our first child, Vaughn and I made that decision that I would first and foremost be a stay-at-home mom rather than working full-time. And it was a great decision, but it's really difficult to live on one salary. Vaughn was making great money, but things were still tight. And I still wanted to make sure I did the savings required for our kids, such as the RESPs, as well as saving for our retirement. So I took finances and put them to the forefront and probably bought every Susie Orman Wealthy Barber book, everything out there, and became the world's #1 traditional financial planning expert, and really saved my 2%, 10% every month, and really kind of set up these different tranches for these savings vehicles in hopes that we were doing the right thing. And I think what a lot of people do is they set it and forget it. And that's what we were doing. So I didn't really understand what I was doing. I was just doing what we could afford to do. And then thinking because we did something, everything would be okay. Now, when 2008 hit, all of our savings took a huge hit. And this is before we were even in real estate, but that was our light bulb moment. That was, we need to do something different. It's time to, invest differently. And that's when we decided real estate is the way.
Well, the RSP thing you were saying, so that you guys, how long did you invest in that? How many years would you say?
So, well, my son was born in, I'd say, we continued to invest in it afterwards. So we started investing in real estate investments.
Well, sorry, when did you start investing in the RESP? What year was that?
So my son was born in 2006.
Okay.
And so it would have been around that time that we were investing. Sorry, my son was born in 2004, this first son.
Oh, okay.
And so by 2008, there was like a little bit of savings in there, and a lot of it was heavily compromised. And that's when we had this light bulb moment. We had another son who was born in 2006, and we started him off right away as well. So we were doing 2 kids at that time in these savings vehicles. And at that time, when the light bulb moment went off, we knew it was time to invest in real estate, but we were still investing in these traditional products until we realized there's another way that we can, aside from real estate, also be growing these registered funds in different products as a passive investor, not just as an active investor. So when we started our journey in real estate, we were 120% active investors. Like, I would never consider a passive investment. I wouldn't consider a joint venture partnership where we were a passive investor. I wouldn't even consider being a private lender. I was about, if it wasn't making like a 48% ROI, I was not interested. I started out with a big head in real estate. Now, fast forward, over 14 years later, I am put my hand up for passive investments all day long, because now I see the beauty of being able to diversify.
Sure.
But those funds that took such a hit from 2008 and slowly continued with the traditional financial planner's advice until they reach a certain age, you have to stop contributing to the fund. So by the time we learned how to self-direct your registered funds and grow these sort of things, this wasn't till, quite a few years later. And because we were so busy being active investors in that terms, that my son, our oldest son's funds, were not able to be removed from the account because you weren't able to contribute anymore. And when he went to school in 2022, September 2022, the amount that we had savings because of that huge hit and we had to regain, it only covered 1 semester.
Oh, for sure. Yeah, I think that's the kind of the sad part about stocks or people that invest in mutual funds, because they might see the financial advisor might say we're averaging 4 or 5% a year. And then next thing you know, there's a big hit like 2008 where the portfolio drops by 30%. And yes, it might be going up 3 or 4% per year, but how many years is that going to take you before you recover that 30% drop, right?
Yeah.
Yeah. And I guess it's the same thing in real estate. It's the exact same concept, but there's just different ways that you can force appreciation and leverage the property and kind of offset those losses.
Well, the way I look at it is when you're playing stocks in mutual funds, they don't really care, first of all, if it loses or if it wins, whatever. They just want to get you into something. They're getting their trailer fees, their commissions, whatever. And usually most advisors, you get asked one question: what's your risk tolerance, low, medium, or high? Then you give that tolerance, then you never hear from them again. Like our first financial planner, by the time we tried to touch base and revamp things, he was in the mountains of Italy or something.
Yeah.
So, they got their thing and they went. And this is what most Canadians are left with. And like I said, they feel like they did something that's good enough. So I feel like the mutual funds and stock markets, because a lot of the advisors go in with this long-term plan of what is it you want to be able to afford, when you retire, and how much mortgage are you going to have to pay off? And it's really not your best life that you're planning for. It's more so this just total guessing projection of this number. And then they say, okay, we're going to make these investments for you, and 50% of them are going to lose, but they're going to be petered out by the other 50%, which is going to create hopefully some gain for you. So I call this a hope and prayer strategy, first of all, because there's no actual analysis behind it that you can get a number at the end of this. And I think that's a horrible way to do your finances. And I think it's playing to lose. I'm not going to accept 50% loss so I can get 50% gain. It's like going to Vegas and putting half on red and half on black.
Yeah.
It's a wash. So in real estate, you can play to win. And you could control your investment. You can plan all these possibilities. So now go forward to what we're dealing with now, high interest rates. I mean, we've been stress testing before stress testing was a thing.
Yeah.
I haven't been doing anything less than 6% since, 2010. Even when the rates were like at 1%, we have mortgages or 2%. We never did our numbers at that. We were always doing our numbers at 6%.
Yeah.
And so I think that's the thing I love about real estate so much is you can think, what can go wrong? And thank God for COVID, which showed us everything possibly that can go wrong.
Yeah.
How can I plan and prepare for that? And what's that going to look like? When it comes to retirement age or when it comes to having to refinance so I can actually help, pay for my kids' schooling, or what strategy can I do to make more money every month? And how can I factor in all these things that might go wrong and think, what are these worst case scenarios? You can do best case scenarios, worst case scenarios, most likely. But if you can make money in a worst case scenario, then you have just mitigated your risk substantially. Whereas with stocks and mutual funds, you're a sitting duck.
Yeah.
You could wake up one morning and all of your savings can be gone. And I don't think people realize what a reality this is and how many people were affected from the stock market crash, even the most recent crash, that were already retired or retiring and relying on those funds. It could be a disaster.
Yeah.
For most people.
Yeah, for sure. Obviously, you've leaned towards investing in real estate. So let's dive into that a little bit. You were telling me about last year what you acquired and sort of the challenges that you were facing. So why don't you share with us a little bit about that?
Well, when we started investing in real estate ages ago, we'd invest in like cheap properties. I started in Northern Ontario. And I'd buy $40,000 homes and rent them out for $1,000 a month. And we took that model and we transferred it over to buying apartments and all this sort of stuff. And we thought that was the way to go. This is when I was in ego, supersonic mode, active investor. I think I was like 48 to 60% returns, blah, blah, blah. Everything was good. And I was convinced this was an area with strong economic fundamentals. And believe me when I tell you, it is not. It was not. Because when the government changed and all roads didn't lead north anymore, we were left with a huge portfolio and our vacancy turned from 0 to very high. Our property management team went bad. And all of a sudden, all these investments were problematic properties. It was like having 100 problems. And so a lot of people, we used to grow our money in these tertiary markets when we revamped, said no more of these cheap homes. Don't do cheap anymore. Do more tertiary markets like the Barries, the K-Dubs, the Hamilton, those sort of areas. And that's what we were really, promoting for years and years and years. But the growth in those markets got so high. Even Windsor, which would have been one of our lower markets, was so high, like unsustainably high. And COVID made all the homes go so high in all these low growth areas. We were laughing. So what we did during the COVID is we did two things. Once, we sold everything. We sold absolutely everything.
Are you talking about in 2020?
Yeah.
Yeah. So you sold every property you own?
We sold all in Northern Ontario, and we sold all of Windsor, and we sold a lot of the tertiary markets. We kept some of the high growth markets, like some of the Barries, some of the Hamilton, whatever. But a lot of these markets that we knew were just at this, like Windsor, which we got for $100,000, is now at $580,000. Like, hello.
That's crazy.
It's never going to be at that again because the real estate goes on the 7-year cycles. So we cashed out, and then the value they were giving us on our house was ridiculous. So we said, okay, Mr. Banker, if my house is worth this, give us a $1 million line of credit. Here we go. Thank you very much. And there you go. People are doing this. So we were selling everything, and we were getting HELOCs and lines of credit and positioning ourselves because your assets really aren't worth anything until you either sell or you refi.
Weren't you worried about capital gains when you decided to sell all this stuff?
No.
Well, so
not at all.
You just factored it in as part of, and you're like, I'd rather just sell it all now because I think this is not sustainable.
Yeah.
I'll take the loss on the capital gains. That's fine.
And a lot of them were with joint venture partners. that we are advising our joint venture partner sales. And we always teach at RPI Education the power of incorporating and corporate structures. So none of it came off as capital gains because we know how to structure ourselves properly and we know how to work with our joint venture partners. So how we claim the income from those sales doesn't come on and isn't charged as a capital gain because we only go on as operating partners.
Right.
So it's really important when you're structuring your partnerships and how you set up your real estate. That's another thing we teach very heavily is because in real estate, you could be an average or high income earner, buy a property, do a transaction, make X amount of money. And real estate, it's like you make a lot of money in real estate. Minimum $75,000 to $175,000 from one refi, easy, all day long. If you do that in your personal name, and I know you can't get taxed on the refinance, but say if you do some sort of flip or some sort of active strategy or any sort of thing, if you don't take the time to talk to that accountant and that lawyer and structure yourself properly beforehand, you're just going to lose all your money in taxes. Yeah. It's just going to be taxed on your personal income.
So just, I know this is an accounting question, so I don't expect you to like give us a detailed answer to this, but because you had the corporations and set up and the joint ventures, when you sold all of these properties, you said you didn't have any capital gains on them?
No.
Okay.
It's all structured as a wash.
And is that because of the corporations?
Yeah.
Yeah, because of the way you have your corporation set up, you were able to do that. Okay.
And because I don't do anything without talking to my lawyer and accountant first.
Sure, of course.
So it's really important to always include your wealth team in there. Like obviously we do pay, tax, but there's a way that you can't evade tax, but you can mitigate tax. And you can reduce tax and you can divert tax. And so we do have a multitude of corporations and we are very, very diligent in what we do, where, and how we structure things. And I never make these decisions on my own. I always use our wealth team to make those decisions.
Of course. That's the way to go for sure, especially when you start to acquire a larger portfolio. You can't take on that risk of not consulting with the right people.
Yeah.
So let's go back to that story. So you liquidate everything. You have the foresight of knowing this is not going to last forever.
Yeah.
And tell me what happens from there.
So we got a bunch of money and then we did 3 acquisitions in the end of Q4. And we ended up
of
actually
2022.
Of 2022.
Yeah.
And we ended up, actually it was kind of mid Q3, Q4, because we were looking all throughout, but we were honing it in even more to higher growth areas. So we're from Markham. We were looking at our own backyard, Markham, Stouffville area, as well as Toronto. And also Calgary has been a great market. And that's where we decided to do our next 3 acquisitions. And actually, we did 4 because we also are doing a flip in Markham as well. And we also started looking in the U.S. too. So during last year, during COVID, or I guess could you even call last year COVID? I'm not sure.
I don't know anymore.
AC after COVID. We did have lockdowns, so things were still happening. It was really hard to get the properties because there were so many bidding wars. You couldn't have conditions. Things were sky high. But we still managed to secure these 3 buy, rent, hold properties for way below fair market
you
value.
said these are in Calgary, the 3 that you bought?
We had 1 in Calgary.
Okay.
We had 1 downtown Toronto. And then we had 1 in Markham. Actually, 2 in Markham. 1 we're currently flipping with partners, and another one is our buy, rent, hold in Markham.
So you decided to sell everything in 2020 and hold off for the next basically 2 years before getting into the market again. Why did you do that?
Oh no, we were looking. Everything was sort of happening. Like you have to realize in 2020, when things were happening, it takes time to do things, to sell, to refinance, all this sort of stuff. Real estate's not overnight. So this is 2020 when COVID starts, things are going high, goes into 2021 sort of thing. And so everything is sold, everything's refinanced, the money's there, ready to go. And then from that point, that's when we started buying. We didn't find those deals until that later end of the 2022.
Yeah, because things were going nuts in 2021, just like 2020. You're seeing increases sometimes of like 20% in a matter of 2-3 months in some markets. So you're thinking this doesn't make sense, especially if you're running your numbers at 6% interest, right?
Yeah.
So it wasn't until 2022, let's say around March, things started to come down because that's when they started raising rates. And then you're all of a sudden starting to find these different opportunities.
There's still I'm actually impressed myself with finding the opportunities, because they still really are the high growth areas that we're focusing on. So I don't even do tertiary markets alone for our own personal portfolio anymore. I focus on cities. So I want Toronto, I want Markham, because I think the best investment anyone can ever make is in their own backyard. Like you mentioned before, you're from Brampton. If I were you, I'd just be doing Brampton all day long. There's so much opportunity in Brampton. But me, I'm not investing in Brampton because I don't understand that market.
I don't understand it either. And
yeah.
I don't like it as an investment.
Oh, you are sitting on gold, my friend. On gold, on gold, on gold. I'm telling you, we have one of our students, our members at RPI, and she is in that Mississauga, Brampton area, and she's been doing incredible things in that market, really being that expert in her own backyard, because it really is about finding the great deals. When we found this property in Markham, it's right by Markham Main Street, I secured this property for $800,000. Now, anyone who's from Markham knows it's impossible to find anything under $1.3 million. Maybe you could find like a one-bedroom condo for $800,000, but this is actually a renovated duplex already in a beautiful building. And so it was just, if you put enough deals and you know what you're looking for out there, you have to put 100 offers in a lot of the time, look at 10 properties and close on one. And that's the same thing we've been doing for the last 14 years. But with this market, because I understood this market so well, when the property came up and I saw that price, and I could only afford to do multifamily in Markham because it's very, very, very hard to do single family in this market. But because we understood it so well, this is the kind of thing that we wanted to focus on, and we were able to act fast and even, get a home inspection in the time where you weren't getting these home inspections, and actually get that accepted offer. So it's almost like luck in the sense that you have to be in it to win it. And a lot of people think, oh, I'm never going to find these properties for these prices. You have to know what your numbers are and know what will make it work. I knew this was a $1.1 million property. And I knew I was kidding when I put in the original offer. And when they started negotiating back and we settled on $800,000, you know that you're just sitting on gold right there. And the same even with the Calgary property. That was about $150,000 of equity that we made when we bought that property. And for the Toronto property, it was actually a condo in downtown Toronto, great area, just outside St. Mike's Hospital. And I don't even usually do condos, but I knew that this area, getting something for $460,000, and this is a 612 square foot condo, prime area, I knew the value of that. That was $600,000. I could go on the MLS and see that was, and we just refinanced that now already since acquiring it for $600,000. So I've not only got it and made money when I bought it, but then did slight renovations to it, renovate it, refinance it at the $600,000, and pulled all the money out again to pay off that line of credit that we've been using.
Right.
So that's what our real goal is now, is rather than having like 100 of these substandard properties, to create a $20 million portfolio off 10 properties. And that's just for your personal wealth building. And that's just the real estate component of the wealth plan. And we also do a lot with partners. We are building 21 homes in Florida right now. That is with partners. We're flipping a house in Markham. We ended up securing that for $745,000. It's on the market now for 1.108. So that's exciting. And that got stuck on the market too. With the higher interest rates, it's actually been sitting. So it's been sitting for 60 days now. So, because our flips are fast, we only take 12 weeks to complete. And that was for a full house gut. And we have really great contractors. We were able to do it at a really great expense. It's not a huge expensive project, even though it is a full gut house renovation. And even though we did a great job, now the property's sitting. And to make matters worse, our neighbor... Well, the problem we actually had to begin with is sometimes we buy properties so low, we shoot ourselves in the foot because we ruin our own comps. So this is something people have to kind of watch out for too. If you start ruining your own comparables, because people don't like it. They were like, they could see what you got the property for, and they get a little annoyed that you're asking so much for that uplift. But I always say, if you're in an area that needs housing, people can see past that, and it's none of their business that you can negotiate such a great deal and, secure properties for that price. What do they care? I don't think that way. But our neighbors ended up selling for $1 million. And so once again, we're dealing with that comp. So of course, I think that time in real estate fixes everything. With house flips, generally speaking, the way we've done them in the past, we usually do a few a year, is we go in. I've done a lot in Markham of house flips. Is we go in, we're done in 12 weeks. So it's a 5-month process from acquisition to renos to sale, like sold price. And we always do it that way. And this is the first house flip that we've actually had that has been sitting for 60 days. So we're going to wait and see what happens on the spring market, because I'm still looking at comps. I'm still very, very confident in this investment, in this price. I will not budge on the price. So we'll either sit and wait just for maybe another 30 days, or then just refinance it and hold it, because we won't buy anything without secondary suite potential. And that's the one thing that attracted us to this property. Is one of our main goals with the Build 23 is to be adding additional housing units, and anything that has that secondary suite, we are finishing off the other unit. For this, we kept it as a single family home with an in-law suite, because in Markham, a lot of families live together and they need those mortgage helpers. They need more than one family on the mortgage. And so we made it possible to do that, or we could just simply put up a wall, rent out the basement, rent out the main floor, and we're actually even looking at building a third unit in the backyard. And we're planning on doing a lot of that in 2023 as well.
Just out of curiosity, on that house that you have on the market right now, what would you get in rent top and bottom?
Okay. So the rental market is another huge pain in the butt lately. I know everyone always talks about how expensive housing is for renters, and how when you focus on these great areas and these great markets, you can command this high rent. Like Toronto, you can command such high rent, and in Markham, you can command, and you can't. It is all over the map for the rents. If you do any research on like Kijiji, on MLS or whatever, there really is no rhyme or reason for what the going rental rate is. And people will still approach you for some of these units and offer such low rent. It's like almost an insult. So, and then you also have our renters on the other side who ended up renting out the units, and they had the same configuration because it's a semi-detached home. And they ended up renting out their basement for like $1,000. And that is just ruins it for you, because then other people will look. But you know what? With real estate investing, you need to decide what numbers work and what you could do to control these numbers, and how can you command a greater rent. Okay, so as an investor, you have to be in charge of these situations. So what I have done to get some sort of control over these situations is midterm executive rentals. So I furnish the units and I offer them to professionals. And for that, whereas for our duplex in Markham, one of the units, like today, someone tried to approach me for a long-term rental for $2,000 a month.
For the house that you have on the market, you mean?
For the one existing rental property that we have. And I said $2,000 a month. Like, you got to be kidding me here. As a midterm executive rental, that is $3,500 a month for each unit I'm commanding. I can get $7,000 a month for these sort of units.
So are you saying in that example of that house that you have on the market, if you converted that into a midterm executive rental, you'd get roughly $7,000 a month?
So for that unit, all I have to do is put up one wall by the kitchen and have 2 units. So I could easily rent out that bottom unit, easily rent it out for anywhere for $2,000 to $2,500 a month, all inclusive, it's all there. Like your Wi-Fi's there. Everything's there. Someone just moves in. It has to be a minimum of 30 days. And then they can move out for the next people. And then the top floor would be $3,500.
Okay. And that's worked out well for you, you'd say, in the last little while? Because I know, so we were talking about the 3 properties that you purchased, and I know you were saying that you were having some issues with cash flow because the rates have gone up so much.
Yeah.
The solution to that has been midterm rentals, would you say?
Yeah. So midterm rentals have been better than the Airbnb model because we did some of the Airbnb too. That's been really interesting. So what I would describe to you is real estate's not easy. And we've had vacancy issues with between Airbnbs. We also got shut down in Airbnb in Markham. I guess our neighbors dubbed us in because it was like a gray area. So now it's back to the executive term. So anyone who's banking on Airbnb, always have a plan B, not just an Airbnb, a plan B and a plan C. This is another reason why real estate is such a great investment, because Airbnb can go away at any time. They can take that away, and the townships are fighting tooth and nail to get it. So if anyone's only strategy to make these cash flow positives Airbnb, you need another strategy. So, and we always had it priced out for the long-term rentals can sustain itself. So that's been a problem. We had our place in Calgary, which has been a problem. We had a problematic tenant actually move in, but the best thing about Calgary, and all our Ontario experts will love this, they got out in like less than a month. So Calgary is a fantastic place because it is not tenant friendly. It's more landlord friendly. Whereas in Ontario, it's more tenant friendly. Once someone moves in, it's really difficult to get them out, which is another reason I love the short-term rentals. And now with the Toronto market, we've been doing those for the not allowed to do Airbnb in a lot of Toronto areas. So you have to follow the rules, guys, because this is a big penalty. When we got that letter, and I knew it was a gray area. It's between $25,000 penalty for an individual, $50,000 penalty for a corporation. And as I said, we're incorporated, so you could be in like real trouble. So and it's a lot of work to do the midterm executive, and it's a lot of work to do Airbnb. But you don't build a $20 million portfolio without doing some work. If you want to do that, be a passive investor, and this is why I love passive investment so much. Write a check for an investment that you understand, that all you have to do is write a check, you understand what the returns are, and let someone else do all the work for you, and you just get your return. And today, you could still get a decent return and have a diversified portfolio where you're not playing to lose, you're playing to win, as long as you understand your investments and you understand what you're investing in.
Just to go back to that letter you got about the Airbnb unit, was that like a warning, or so you didn't actually get the fine?
No.
Oh, okay.
It was a warning, and then they charged me like $150 or $115. They're going to take it off my taxes because of all the trouble they had to go through to write me the letter. And
okay. Well, that's better than $50,000. Yeah, for sure. Okay, so these are the 3 properties that you bought last year, and you were telling me that you were planning on buying 3 more this year.
Yeah.
So tell me about what you're planning on doing.
So what I'm looking to do is I am looking to buy either infill lots, preferably with an existing structure on it, and developing it to 2-3 unit homes. And so what we like to do is to take that single family home and create these income helpers. And one of the main ways to do this is the same thing we did on this flip house that we did in Markham, is finish the basement as this in-law suite, because the greatest appreciation is in the single family home. And you can have the in-laws or someone else stay down there, or they can rent that out if they choose. And then as well as have the additional accessory dwelling unit in the backyard or as attached on top of the garage. So now you have 3 units in one property. So what this allows you to do as an investor, when we hold these properties, first we need to buy it right. Then we actually increase the value through this forced appreciation, which should be increasing the value at least $250,000 right there. Then refinancing, pulling out the money to pay yourself back, and you can hold the investment in a high growth area, and now you have 3 units you can rent. You can take the first unit and you can rent it to one family for a higher price, and they could sort out that rent for the 2 units, or you could have the 3 separate units. I prefer to rent it out to people who can pay more, and it's like fewer people, or it's amongst themselves. Soon as you start getting into multifamily housing, your tenant quality goes down. I'm sorry, but that's just a reality. More people, more problems. Sorry, I touched the mic again.
It's okay.
More people, more problems. And there isn't any greater appreciation than that single family home. So the accessory dwelling units, or these garden suites, or the ADUs, whatever people are calling them, are a phenomenal way for the family to have the privacy that they want. And then you could start commanding like $3,500 a month rent and be renting out the suite in the back for another $2,000 a month. And neither tenant is compromised, because the tenants that we look for are Henrys, high earners, not rich yet. That is our ideal tenant. We have a lot of passive investments with people that actually base their entire apartment model on this. And you always want the Henrys, because they are the ones that are not going to stay in your property forever and ever and ever, because they're progressive people. They expect a good looking property in a high growth area. They'll stay there probably a year and a half, then they'll leave, and then you can up the rents and you can get another Henry. So
just to clarify on that, the reason that you target Henrys is because we live in Ontario, where there's rent control. There's the rules are so much in favor of tenants. You're not able to get a tenant out easily. It takes a long time to evict a tenant if they're not paying rent. So there's all these reasons. That's why you want these people that are probably young professionals, have good jobs, good credit, and like you said, they're not staying forever, because you get to reset that rent when they leave.
Yep.
Whereas if you are investing in Calgary, you don't mind getting that probably older person that's gonna maybe be there for life, because you're able to adjust rent to market rent on a regular basis, and if they don't pay, you can get them out much more easily.
Right. Well, I still have a Henry in Calgary too, but because we bought a beautiful place there. But yeah, you're right. Like, I'm terrified of tenants. Sorry, but I am. Like, we're viewing this property in St. Catharines, actually, because my son needs a place to rent next year. So St. Catharines is an amazing market, but it's very expensive now. And we've located a property near the school for a fraction of the cost. Well, I'm working with my specialist there to get in. We're supposed to go up this Friday and pick him up. I said, let's view. And you know what she told me? The tenants only want viewings between 5 and 7. That's how much control the tenants have. They can even tell you. And then the tenants don't want you to take video footage and record the live, because we'll do a lot of live walkthroughs. And so if we can't go up and see the property initially, and the tenants don't want anything recorded. Like, this is how much pulled. I don't know who owns the property here, the landlord or the tenants.
Right.
Like, it seems the tenants have all the control. And when you're buying things and holding them at this interest rate, and the worst strategy in real estate investing that you could do is and you'll see real estate agents do this all the time, will be cash flow positive when you can easily raise rents. You cannot easily raise rents in Ontario. You need to get these properties vacant upon possession and be able to set the market. Like, the fair market rents are hard enough to cash flow at. Never mind just getting people out. And people glamorize it with this cash for keys and this and that. And true, you will have to do cash for keys sometimes, but make it the existing owner's problem. Make them get that tenant out before you close that property, and make that contingent on your deal. And if you need to put money for a cash on keys, whatever, participate, but you will not close on that property till that property is vacant, because soon, and you have nothing to do with it. So the second you talk to that tenant and you start negotiating cash on keys, you've inherited a huge problem.
Sure.
You just talk through the agent. I want it vacant upon possession. I need this vacant. Don't even tell them you're moving in, because you can get in trouble for that. Don't tell any lies.
You'd have to sign an affidavit if you are saying that you're moving in today. I think they're becoming very strict on that. But yeah, I agree with you. Vacant possession is extremely important to ask for. Although in my experience, it's not often that the owner is willing to do it, because they understand how difficult it is as well.
Yeah.
So maybe it's just better to walk away from the property. But I had a case where I was representing a buyer, because I'm also an agent. I don't know if you knew that, but we wanted a building that was to be vacant. The owner was like 90% sure he can give us vacant possession, but we had put a clause in there just in case he can't, that we would get a reduction in the price on closing. And the client that's what he wanted. Like he was okay with that. So luckily we did get vacant possession on that. But I definitely wouldn't want to take that on myself and bank on getting the tenants out if that's the only way to make the deal work.
Yeah, absolutely. And, don't get involved in the why or whatever they say. Why do you want it vacant? Don't give an answer. Just say, because I do.
Yeah.
And if they can't give that to you, like you said, and if you are going to have a reduction, then at least have it, like account for that difference in that rent that you're taking in, and account for that over a prolonged period of time.
Yeah.
Like a 5-year period of time. And that could accrue substantially.
Yeah. Or you can factor in cash for keys. Like let's just say you can get a $50,000 reduction. Well, maybe you offer a good chunk of that to the tenant and see if they're willing to go.
Yep.
Yeah.
But you know what, George? I don't negotiate with terrorists. We've done it once again. Even with the cash for keys, I would encourage through the agent, the owner, to consider that or find out, what's happening. But even right now for this property, which my son would be moving into, so that is a legit claim that he would. You have a family member and they're moving into this property, and that actually works. But even knowing what I know already, that we're even having difficulties viewing the property, you can imagine what you're dealing with.
Well, that means there's a good deal.
Yeah. Oh, exactly. Well, that's what I'm happy about, because it's keeping everyone else away.
Exactly.
And then at least we could get into that property.
For sure. The more challenges you have with seeing a property, probably the better it is for you, because think of how many people are walking away when they face that challenge. Oh, I can't see it. I can only see between 5 and 7. All right, I won't go there.
Yeah.
Now all of a sudden that opportunity is there for you.
Exactly. And that's your job as an investor, to really kind of focus, be able to spot and find these great deals, create these great deals. Don't be scared to offer low, but know how much money that you need to buy this property for to mitigate all the risk that it takes in real estate investing today, and how to deal with the high interest rates, deal with potential property drops. They say now property market's going up, it's going down, it's going up, it's going down. Like, we don't know. You just have to know, for you as an investor, how to protect yourself in advance, and how can you continue to carry these properties. For
sure. Let's dive into Florida, because you mentioned the 21 homes that you have there. How did you get involved with that, and what's just really quickly, like, what's the game plan there?
So there's a lot of growth in the U.S. and RPI Education now, like I was mentioning before, we have 30 chapters all out across Canada, as well as the U.S., the U.K., and Australia. And our team in Florida has identified, we partner with a builder and are able to build these brand new homes in a high growth area at cost, basically, and sell them this area of Florida, which is a little more, it's not the Miami, it's not near the beach, it's not vacation properties, we're not going to Disney World. I think you need to be a little more elevated when you're looking at properties and U.S. investments than that. It's an area where there actually has a population growth of 300,000 people coming in, and 30,000 jobs being created, and they need housing. And our team actually happens to live in this area of Florida, and it's like about an hour and a half from Fort Myers, an hour and a half from Orlando, an hour and a half from Sarasota. So it's more of that inland kind of portion that most people aren't even looking at. And building these properties are already selling. We're selling them as pre-construction housing flips, because there's such a need for housing in this area. So we're at completion, I think, next week, and then the houses are on the market. Some of them are already on the market. Negotiations are in place, and after that, we're going to be doing another round of homes in this area, partnering with the same builder.
Cool. Awesome. That's a really cool project. So you're involved in what, like, just out of curiosity, what capacity?
So we're operating partner with Canadians, helping them invest in the U.S. So we connected these Canadian investors to this opportunity. And although they're the equity partners, they're responsible for funding the deal, funding all the payments. They're actually on title for the investments. We're on title as their joint venture partner to operate the partner, communicate with the team. We put the whole team together and just managing all the operations and corresponding with the investors.
Cool. Yeah, that's an interesting opportunity. A lot of people are starting to go down to Florida and to the U.S. in general and explore opportunities there, I guess, for investors. A lot of it has to do with the landlord-tenant board and whatnot, but that's awesome that you're getting that done. Do you feel like there's anything else we should touch on before we end things here?
I think we've talked about a lot. I think it's been a really great conversation. Unless you have another surprise question for me, because you've been surprising me this whole podcast.
I don't. I used to do a random 5, like a couple of years ago when I first started, where I'd ask every episode 5 random questions to the guests, but I haven't been doing that lately. Do you just want to tell people the best way to reach you and the services that you're providing?
Excellent. Yes, for sure. So the best way to reach us is rpieducation.com. We're providing wealth consulting services. We have different coaching programs, different programs that people can go through to build wealth. We strongly believe traditional financial planning is not working. You can't trust the banks this day and age. It's time to invest different, and you can work with a wealth team that actually really is doing it themselves and really knows how to build wealth in real time, just not teaching a cookie cutter course. And so if you book a call on the discovery call, you can book it on our page at rpieducation.com.
Cool. Monika, thank you. It's nice seeing you again. It's been a couple of years, and I'm glad we got to catch up.
Excellent. Thank you so much.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.